Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, November 22nd, 5 o'clock Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, bear market rally continues. You can see over here on the trend gauge, long term, we're showing red. That's the significance of the bear market as we broke below the 200-day moving average earlier this year and really haven't recovered for the most important indexes. That's the S&P 500 and the NASDAQ 100. Back above on the Dow and the mid caps, struggling on small caps, but short term and medium term, we've been participating in this rally off the bottom since the positive reversal back in October. Market leaders showing bullish short term using the 21-day exponential moving average, and medium term using the 50-day moving average. All five of those indexes, the major indexes, are trending above those levels. So they are flashing bullish slash uptrend. As far as what happened today, seasonal strength kicked in. Thanksgiving week, Tuesday through Friday in particular, is 75% bullish. And that's pretty much what we saw today. After a lackluster sell-off yesterday, where the market bounced around this key 3950 area on the S&P most of the day, a little bit of strength into the late afternoon, 0.5% gap up in the morning, and really just trending higher most of the day. Let's just call it seasonal strength kicking in, but into resistance. We'll talk about three key levels on the S&P 500 that are overhead that could put a halt to this move higher, or if we break through it, could set us up for the next leg to the upside. Green across the board today. G6, this is our 6 ETF growth composite, up 1.54%, S&P 500 up 1.36%. NASDAQ 100 lagged early, came on strong late afternoon and throughout the morning, up 1.4%, Dow up 1.2%, mid caps up 1.65%, Russell 2000 small caps up 1.2%, global diversified 60/40 stock and bond up 0.9%, in-house GROTECTION up 1.29%, equal contribution from our leading stocks that we own and from the index long that we own. Then we'll go through the tail of the tape and charts of interest. Let's dive into what we do here at Revere and why we do it. Keep in mind this trend gauge when I describe what we do. This has a lot to do with how we allocate client capital to the market. So Revere is a registered investment advisor. We're not a mutual fund, not a hedge fund. We manage separate client accounts on a fee-only basis, fully transparent, no conflicts of interest. That means we don't get paid by anybody to push their products, and we're registered with the SEC, which means we manage over $120 million, over $100 million. We're approaching 130 million. Our flagship portfolio is called GROTECTION, and it's designed to grow assets during market uptrends, protect assets during market downtrends, and there's a lot of gray areas in between there, and we have varying levels of exposure to the market depending on what the market's doing. Ideally, look back here on October, November, we're trending above all three time frames. We'll have as much capital committed to the market as we are comfortable doing. If we go sideways, some of our stops will get hit to the upside, also to the downside. We start to roll over and head lower. We'll see the slopes of the lines of the short-term and medium-term moving averages start to roll over. That's going to get our attention for sure, and we'll be reducing exposure then. If we break below this black line here, that's the 200-day moving average. And you're familiar with this chart by now if you follow us. This is what we aim to avoid. Risk management, our number one job here. You take care of your drawdowns, the returns will take care of themselves in a healthy market. Nobody wants to be approaching retirement and see half of their nest egg disappeared into thin air, basically taken back by a harsh market correction. That's called a negative sequence of returns scenario. The market returns about 8 to 9% every year. On average, but certainly not every year. And if you get a -20, -30, year back to back, or 1 year where you're down hard. We were down 27.5% this year at the bottom. It takes a lot to recover there from that, and it takes a lot of time too, time that you might not have before you need to start drawing on those funds to fund your retirement. So that's why we pay special attention to the downside. If you're interested in an approach like this, shoot me an email, don@revereasset.com. You can also email my partner, Danny Stewart. He's CFA and the president of Revere, dan@revereasset.com, and he will have an answer for any financial question that you might have, and if he doesn't, he'll know where to get it. Or you can call us at 855-REAL-WEALTH. That's 855-732-5932. So yeah, we have sell rules to get us out. We also have buy rules to get us back in, and those kicked in on October 13th with this undercut of recent support and slingshot back above. This is very often how bottoms are put in. Doesn't mean it's a permanent situation. You saw slingshots here back in July through August, but then we rolled over when we came into the 200-day moving average. We've had a nice move off the lows now in a 2 steps up, 1 step back motion, but we're coming into this declining black line, the 200-day moving average. 3 key levels. We'll talk about them when we get to the tail of the tape. But basically, all within 1.4% to the upside. And not to mention, we closed above it today, but the 4,000 this 4,000 level is psychological support, with it being the round number, but it's the first. We've got several steps above it over the last 2 weeks, but no closes above it. Today, the first close above that key 4,000 level. So that's the S&P 500. Let's go to the tech-heavy NASDAQ 100. You can see pulling back. This is actually a nice little bull flag, lagging from a relative strength perspective, coming right into the 21-day moving average and the 8 moving average, and we bounced up off of it today. But this is the furthest from its 200-day moving average at 7.1% down. Those big tech stocks, most of the charts are a mess, and that's the reason for the NASDAQ 100 being in the relatively weak position that it is in. Speaking, the opposite of relatively weak would be the strength of the Dow Jones Industrial Average. Strength from a price standpoint, as it's the furthest extended back above the 200-day moving average, and had its first close above this 34,000 level since back in early August. Not on a relative basis though, and this is actually a good sign. So what you're seeing is price making a newer high before the relative strength made a new high. We look all the time when we're scanning for leading stocks for sectors and stocks that are making a relative new high before their price does. It's considered a sign of weakness when the price does before the relative strength does. It means that the strength is waning, and that's fine. We've been talking about this over the past week or so, as we just really went sideways since the gap up. But that's part of the rotation out of these more defensive and considered safe growth stocks, which populate the Dow Jones Industrial Average, and a move more into not necessarily the top 7 or 6 that make up the S&P, that make up the NASDAQ 100 and the S&P 500, but into semiconductors, into solars, into other growth areas that are going to propel the S&P and the NASDAQ 100 higher on a quicker basis, relatively speaking, than the Dow will, and that's a good thing, and I'm quite okay with it. Let's go to MDY mid caps. 1, 2, 3, 4, 5, 6, 7, 8 closes now above the 200-day moving average. Good stuff there. The 21-day. Late this week or early next week will come up through the 200-day. That's another sign of strength. Mid caps, weeks, go back 4 weeks and 3 weeks ago, we're showing relative strength, kind of staying in line with the S&P since then. Good stuff there. IWM, small caps have been lagging a little bit as of late over the last week and a half. Really, this is cluttered up, but really over the last 2.5 weeks. So really mid caps have been where the strength is, and unable to get back above the 200-day moving average yet after One close above, a close below, another close above. We played this, got stopped out when we broke back below the 200-day moving average, but that's okay. We put those funds into the S&P 500 as it makes its attempt off of its shorter term moving averages to get back above its 200-day moving average. Another few key charts to go through here. The dollar was down today. You know from listening to us that a weak dollar is good for stocks, and we saw that uh, correlation or anti-correlation, inverse correlation held today also. The VIX, big move down today, new recent lows. Coming into an area, if you look back here to April and to August, where it bottomed. And this could be a pause area. This could correspond to a pausing area for stocks as well. Note it was oversold for like 3-4 weeks back in August while the market trudged higher. We've been oversold, got out of oversold just for a couple of days now, back into oversold on the VIX. That corresponds to overbought on the S&P, and you'll see that. Or you saw that if you checked the stochastic when we did the S&P chart. We'll check it again here momentarily. But again, and this is also corresponds to us coming into this overhead resistance on the S&P 500. So maybe there are several things lining up that say we may be due for a pause as we try to process our way throughout the 4,000 to 4,100 level on the S&P. There's the VIX. Let's look at gold. We bought gold stocks today, not gold. Gold kind of lagged, only barely positive, which was disappointing considering how much the dollar was down. But you did see 3 big volume days on GLD over the past 2.5 weeks, just kind of pulling back on lighter volume now. Bitcoin BITO up 2% on the day. Let's go to the 60-minute chart to get a better look here, and still no recovery from this big sell-off as the FTX mystery just continues to deepen. Let's take a shift over to bonds now. TLT, this is the price of the longer term bonds, and this is actually following through to the upside. We got one close back above the 50-day. The 50-day is flattening out, 3 days of consolidation, and a higher high on the TLT. This means interest rates are pulling back. We're coming into overbought on the stochastic. But this is kind of the setup that would make us start looking at bonds if stocks weren't doing as well as they were doing. But this gives an alternative to, at least it's uptrending now, and we can no longer say that buying bonds would be like buying rotten vegetables to have a balanced diet. So what we obviously want to keep an eye on, like we do every day, is how this trend continues, because this is kind of the market thinking that the Fed may be coming to a pausing area on raising rates, no matter how many times they say they're not. So you can see here, here's the 10-year note, yield a little bit lower today, not as low as it was over a week ago, so a little bit of a divergence there, but we are into oversold on yields. Let's look at the 30-year, the TYX did make a lower low and also an oversold. So corresponding to the TLT from that standpoint, with it making a higher high. Let's look at junk bonds. No problems here at all. Certainly not flagging or showing any issue in the credit markets as it continues to act healthy. BND is a broad bond index. And this is now above its 50-day moving average, with the 21 coming up through the 50. So we can no longer talk badly about bonds, even though the longer term trend is down, but the short and medium term trend on bonds is now higher. So how about that? What's next? Let's get into the tail of the tape. Stochastic on all of the major indexes turned up, so that's a technical plus. On the G6, we're mixed, which is better than down, which is what they all were prior to today. The NASDAQ McClellan Summation Index and its RSI are all pointing higher. Dollar under the 21, but oversold. TNX and TYX, the 10 and the 30 year, are below their 21, but they're also oversold. Put call up to 1.16, kind of volatile today. Don't really have an explanation for that. VIX down 4.8% to 21. We already showed the chart on that. Fear and greed unchanged at a 62, operating under the bull case with continued strength that we saw today. That fits with that. A little bit of news today. We had 3 Fed speakers, but no noticeable impact to the markets. At least Bullard was one of the speakers. He was the guy that reversed the markets last week by mentioning a possible 7% terminal interest rate, but he didn't do anything to roil the markets today as they were strong into the close. However, risk of the rail strike is rising as one of the unions rejected the latest offer. Day count, we went from 1 up day with a consolidation day to now up 2 out of 3 with the continued strength. I already talked about from a seasonality perspective, this is a bullish week. Expectations, positive as long as we're above 3,900. Going to change this to 3,950. That should hold on any pullback, and that was confirmed today with the move above 4,000. You can see we're up into this 4,007 fib. Today's high was 4,006. Let's see if we can blow through it overnight or tomorrow. This other fib level, 286.82, we're approaching that. Didn't get into it, just shy of it today on the NASDAQ 100, but certainly that's improvement. I talked about how we, let's look at the S&P 500, and do notice here that we are in overbought, as I mentioned. But let's look at a 5-minute chart and see what we did here today. So we did have the gap up, sold off immediately, but little cup made a higher high. And then the opening high through 10:30 was around this 39.83 area. Nice flat base for about 2.5 hours. And then we broke out at 110, 107 on a 1-minute chart. And then just trended higher into the day. So this is a good look. It's what the bulls would certainly want to see. Volume wasn't overwhelming, what you wouldn't expect that on a holiday week, but the price action certainly was there. Strength today in bonds, oils, GDX, XME, and retail. Some things that were red early, but changed to nice closes. XL, CKY, those are the 3 tech sectors, also biotech. These closed positive but lagged on a relative basis. Real estate, solars, and ITA, which is aerospace and defense. The only thing noticeable down was the dollar, which is a headwind for stocks. Focus list, we'll go over these charts in a minute. In-house, we added 3% GDX, 1% to SHLX, that solar stock I've been watching. Bottom line today, strong move up, but approaching heavy resistance area. And there's 3 levels overhead for tomorrow. These numbers will change slightly as when the market opens. They change by a couple points every day. But what won't change is this 4,007. That's a 61.8% key fib level of the 3rd leg down. We failed at it twice last week. We're into it again right now. As I said, high of the day was 1 point below that. And then the next level up will be 40.42, which is the 40-week moving average on a weekly chart, and then 20 points above that, 40.62. This will be around 40.60 when we open tomorrow. But 1.4% above multiple key levels that we've got to get through on the S&P 500 in order to clear the 200-day moving average / 40-week moving average, and see if we can continue this strength into late November and early December. So those are the key levels. Let's bring up the focus list and go through some charts. And one thing I want to point out, somebody commented on our video, how did I not get stopped out on Mobileye? And if you see the title of today's video, it's when is a 7 to 8% stop not wide enough? And I've gone through several examples of this recently, but if you buy a stock like Mobileye, HLIT, no, not HLIT, Mobileye, Celsius, PI, a lot of these stocks that are big movers have ATRs of 8, 9, 10% when they move. You can't set a 7% stop, even if you buy it perfect at the pivot, on a stock that has a 10% ATR. That's a normal volatile move down. It sucks, no question about it. I'm sure multiple people got stopped out yesterday on Mobileye. It was down yesterday by 4%, but it's had two rough days back to back. That's the price you pay for having a day like today where it was up 8.5%. That ATR is just that. It's an average true range. You can very easily have a 10, 11, 12% day, even double that when your ATR is 8%. It's an average. Um, and you have to size, and I've learned this the hard way, you have to size down in order to not get shaken out. One of William O'Neill's uh, one of his most famous sayings is, "There's nothing worse than a sold out bull." That's a quote that Mike Webster, Justin Nielsen, Charles Harris, I've heard them all say it. And it's because you're sized too big to weather the harsh pullbacks. And I got booted out on AEHR in a very similar manner when it had harsh pullbacks over here 3 days in a row. This total pullback was a little over 2.5 ATR. I had a 2 and then a 3% position, and I just got stopped out when we went below the 21-day exponential moving average. If I'd have maybe sold half of it and held on to half of it, I could have participated in this recovery. But there is nothing worse, and I know I'm not saying ignore your stops. What I'm saying is, in some of these big stocks that have wide ATRs, the only solution to not get shaken out is to size down. So we've bought 3 1% positions on this, and at the close yesterday, even at the lows, the last buy was down 9.8%. The others were down 6%, and one was down 4%. But what we try to do on these 1% positions with the wide ATR is really the limit. The most that we want to lose is 0.1% on a 1% size. When I say, and I've said it frequently, that we try not to lose more than 0.2% on any position, that would be buying a half and then, or buying a quarter and then buying another quarter. So on average, a 4% position. We don't want to lose more than 5% on that. That would be 0.2% of the portfolio. But that varies depending on the ATR. We'll size down if the ATR is bigger. We'll size up if the ATR is smaller. But in the case of the 3% that we held here, we didn't reach minus 0.1%. On the downside of that third buy. So even though we're showing that we're below this minus 7 to 8%, the ATR of this stock is just too wide to be able to use that as a stock. I've said multiple times that's one of the things where we varied on the typical O'Neill rules, and I just think you have to do it because of how volatile some of today's leading stocks are. So that's the story on that. Let's go to SHLS. This is another one. It has about an 8 to 9% ATR after this gap up over the last 6 days. There was a big seller sitting at 30 today. When that cleared late in the day, we took a 1% size on it. And again, these more volatile ones, we're going to step in 1%. We make progress, we'll step in another percent, make progress again, maybe a third percent. I used to kind of hold fast to the rule that I really didn't. I'd prefer to have $100 million daily dollar volume, but we were missing a lot of stocks. And if we size down and approach it a percent at a time, I'd rather participate in a 50, 60, 70% gain and have a 3 or 4% position than miss it completely. And we've set limits for how much of a percent we're going to have in the portfolio of these thinner stocks with these wider ATRs. But so far, the net on this recovery off the low has been more profit than loss. So we're going to stick with it. We're always looking to improve and do better for clients. And we just want to, that's one of the reasons why we're discussing, at some point we just can't. We would have to close GROTECTION at some point and create a second version of it, which would just be limited to the more liquid stocks. But for the people that have been with us for a while and new clients, we think we can handle this just fine by taking smaller position sizes and widening widening the stops. So that's SHLX. GDX is what we bought today. Now, I have a list of all gold stocks, and I brought it up today. It's got about 30 names in it, 25 names, whatever. Sorted it by 3-month relative strength, and every one of them was like an 80 or higher. So that tells me that it's a group move, and it also tells me that I may not be smart enough to pick the one of those 20 or 25 stocks that's going to outperform. So I'm fine in this instance going with the ETF that represents a broad selection of gold stocks. We do this with oil also. We've used NRGU, and we currently hold ERX, because when the whole group is moving, and oils and gold is one of these. Steel stocks is doing it right now too. There used to be a steel ETF, but I don't think it exists anymore. SLX, oh, it does still exist, but it's thin. Only trades 27,000 shares a day. Making near a new high. You can see it has nice relative strength on it too, but we went with Steel Dynamics because it was just head and shoulders above the crowd, but I didn't really see anything liquid standing out one above the other on the gold shares, so we just went with GDX and a 3% size on that today. This is also something that has a relatively low beta, so not very often zigs while the S&P is zagging, and that's always welcome. So moving on, CELH, we survived a shakeout on this today. We had a 1.5% position on it, and it was down 9% at one point during the day, broke below the 50, broke below the 21. Couldn't find any news on it whatsoever, but for some reason, somebody wanted to sell it. I hate getting caught in these shakeouts because time after time again, they just go back to the upside. And the fact that we only had a 1.5% position on this was the reason why I was able to hold it. And by the end of the day, call it luck, call it whatever. In a stronger market, try to hold to the end of the day to see if your stock will recover. It's not a guarantee, but if you've got a 20% position in something like this, you've got to have nerves of steel to be able to sit through this, and that is not me. You got to know yourself. You got to know what your risk tolerance is, and again, this is a situation where we'd rather size down, get some gains, and if it's going to be a significant move, we can add to it as the stock grows up, so to speak. And a great example of this is ELF. I was talking about the fellas to this over the weekend. This is a stock that has grown up before our eyes. Alex brought this to our attention back in June, and it was just way too thin at the time, trading under 30 and with an average daily volume of about 572,000 shares a day. Just not thick enough. But now it's up, it's over 50, trading 54, average daily volume 700,000. That's a lot more. That now fits into the category of it would be thick enough for us to get into. And if I was smarter, I would have bought it on this gap up day on 11.3, but I still had it in my brain that this thing wasn't thick enough for us, so I didn't take a close enough look at it, but it is now. And that's a case, again, of taking a smaller position size, thinking you might have the ability to sit through, if it grows up and it graduates and it's a bull market and these get more liquid and the stock gets higher, you can pyramid into it on pullbacks, like to the 50-day moving average. O'Neill was very clever and very good at doing that. So another example of getting in thinner stocks, wider stop, hold on a little bit looser than normal. And that's why we were constantly adjusting our risk matrix for the volatility and the beta and the ATR of individual names, wanting to be able to sit through these pullbacks. So ELF, a good example of one that grew up before our eyes. As I said, AEHR, I already showed this chart. This is one that I got stopped out on, and it looks like it wants to be a leader. Decent day today, not heavy volume. Ideally, the pullback to the 21 here, I'm not going to chase it. We've got 3 thin stocks on board now. We don't want to own more than 4, and we really don't want to own more than 8 to 10% of the portfolio. So we may take a position in this, we may not, but SHLS was the third one that we bought into today that's considered a quote unquote on the thin side, meaning under $100 million in daily dollar volume. But the market has been favoring those lately, not more so than the large cap growth stocks, quite obviously. So AEHRON also on the watch list. Again, perfect bounce off the 21-day last week on this pullback. Nice movement up on it today. Boeing, not a good day today. Down, tight, low volume. If this would get an upgrade or something and shoot off, open one day on massive volume at the open, I would be all over this. I don't want to buy something that's underperforming. We again may be in the situation where these quote unquote safe growth stocks are not outperforming. It certainly didn't today, but this just really looks like it's a nice flag that's being put in after a higher volume move up on the news that they were going to be cash flow positive next year. SANM, a relatively new name that has come across our list recently, flagging nicely after its earnings gap up. LSCC, acting very good. We started digging more into semiconductors because we have been seeing the stocks outperforming the QQQ and definitely some money flowing into that today. This is looking pretty good. Nice reaction since its earnings report, as well as ADI, which was up today on its earnings report, up 6%. This is a nice move off the bottom. Couple day pullback, reported earnings, great canceling fundamental sales and growth and earnings growth. New high off of that, 48% above average volume. GFI, this is a gold stock that Ted has been watching. Fantastic volume here, lighter volume pullback, just what you want to see. He talked about it. We always give our top two names pre-market, make a list so that we're all taking a close eye on the things that each other are looking at. And not that I don't hate this at all, but when I started digging into the relative strength, as I said, on every gold stock that's in my gold list, they were all very high on their 3-month relative strength, which tells me it's a group move, and I just decided to go with GDX. MNST, I drink one of these every morning. Probably not the breakfast of champions, but it's part of my breakfast, and 2 nice days above this $100 area. It's acting better than Celsius. I was sitting here watching Celsius down 8% this morning, wondering why am I drinking a Monster and owning Celsius when I could be owning what I'm drinking. But then again, great volume patterns here too, and Celsius did recover during the day. But Monster, the thing about Monster is, and I know the product very well, they have a lock on the market of zero sugar, really good tasting energy drinks. Most of these things are loaded with sugar and caffeine, but I've got 7 different flavors right now in my refrigerator that are all sugar free, and they all taste fantastic. No aftertaste. They've just done a fantastic job on that, and they're sugar free. So I think that's the product that's propelling it higher. MNST, finally, Apple. On the focus list, everybody wants to see Apple. So held the 21 and the 50 on the pullback, perfect. Volume patterns definitely improving over the last 2 weeks. We want to see this get above the 200-day moving average. So that's going to wrap it. As always, love to hear from you. Email is don@revereasset.com. A little bit longer today as I talked about a couple different topics, but probably worth the time. Ultimately, that's up to you. But we like to be fully transparent here, and we want you thinking. I don't like surprising people when they see, well, why did he do this? He shouldn't have done that. It's going to happen every once in a while, but we want to be transparent enough that you can understand our process, make it simple enough to learn it, make it your own, put your own touches on it. One of the best managers I ever had in IT told me that her job was to train her replacement, find the people on the staff that reported to her that could take over or step into her shoes if she moved along, left the company, got promoted, whatever. And that was always something that I'll always remember. And that's how we treat people on staff at Revere, and that's how we treat our clients and anybody that's following us. Frankly, I want this video to be not something you even need to watch because you know enough about the markets that you could do the video. I can't tell you the last time I read some of the articles in IBD because I mean, I'm doing videos 5 nights a week now. I don't really need to read the big picture anymore. I've got a good enough feel on what the market's doing to not have to do that. And hopefully you guys out there, a few of you are on the same path. So anyway, so that's it. Wrapping up Tuesday, 11/22. This is Don Vandenbord. Remember, it's not how much you make in the markets, it's how much you can keep. Thanks for listening and have a great day.